much, Mary G, for inviting me to guest lecture and to St. Francis College. This is really a pleasure. I love speaking with students and anyone who's starting a business. Is really my passion, so it's great to be here today. And as Mary said, I am going to talk about angel investing, but we both thought it would be instructive to just give you my background on how we started my business and how that all evolved. So the first thing I just want to point out to all of you is I majored in philosophy and Latin American literature. So you're already ahead of the game, being in even this intro course.
A non-business major becoming an entrepreneur.
Yeah, non-business major. I took one econ class, I took one accounting class one summer. So you can do this. If I can do this, you can do this. So that's the first thing I just want to say to you. One thing I did do that I thought was critical to the success of my business is I worked for other people first, and there's a lot of value to that. Probably the most important thing about that is you make your rookie mistakes on someone else's dime, and that's very good. And it's very good when you do it on an employer's dime versus an investor's dime versus your own funds. So I worked for 10 years before I started my own business, and in that work experience, it really fell into two categories. I either worked directly with founders of companies, or I worked in highly entrepreneurial environments. So I started working for a woman who ran a boutique executive search firm, and she basically taught me everything about the business, from answering the phone to analyzing cash flow. So I really think of that as my hands-on MBA. And then around 1997, there started to be a lot of excitement about this thing called the internet. So this is when the internet was really starting to commercialize. So I jumped in, and this was a great time to be part of that industry because none of us knew what we were doing. We all knew it was big. We knew it wasn't only going to change business, it was going to change our lives radically. But none of us knew how to make it work. So that was a great, kind of great to be part of that whole evolution. And my last position there was somewhat more of a corporate position, and I was 8 months pregnant, and I got a call late one night from my boss, and she said, "Hey, do you remember that conversation we had about you starting maternity leave early?" And I said, "Yes, Laura." She said, "Well, I think you should start maternity leave right now. Send me an email effective immediately." I said, "Okay." So the next day, the company announced they're closing the entire New York office and laid everyone off. And some would say, "Oh my gosh, I can't believe that's such a terrible thing that happened to you." And I tended to look at it as exactly the opposite. This was the perfect opportunity to realize my own dream of starting my own business, because here I didn't have a job, but I actually had some money coming in. So I basically used my maternity leave as my seed capital to start my business. So 3 weeks after becoming a parent, 3 weeks after becoming parents, my husband and I announced to family and friends that we were starting our own business. He gave notice at his corporate job, and we were off and running. That first year, we decided to start a business. We knew it was going to consume every ounce of our energy and all of our mind share, so we wanted to do something that we both loved. We wanted to find a passion that we could turn into a business. So we both had this great tradition of gift giving in our families. We loved to give gifts to each other. So we said, okay, we have internet experience. We love to give gifts. Let's have kind of an online gift emporium, and we'll make lots of money. This will be great. And a couple of weeks into the launch of that site, we were looking at the data and realizing what was going on, and we quickly realized this was not going to pay the bills, so we had to come up with plan B. And I'm sure all of your professors and any entrepreneur you talk to will tell you that you have plan A, and plan B, and plan C, and plan D. And the most important thing about starting your own business is not to be wed to your initial idea or impulse, but just to be able to be flexible, resourceful, and think out of the box, and take advantage of the opportunities in the market, everything, and make a business that works. So we decided to do something counter-trend. So everyone was going online, and we said, okay, well let's go offline and open up a brick and mortar store. But we had never even worked in a store, let alone operate one and manage one. So what did we do? Well, we talked to people who had done it, and then we read a book about it. So I read a book, how to open and run a specialty retailer. And we decided this sounds good. I don't think this will work for us. And we were just about to open our business, and of course we were very excited, and we had done all these projections about costs. And lo and behold, we essentially ran out of money. Which is, if you don't run out of money starting a business, something is wrong, basically. Mary will tell you that from all the businesses she has seen. Capital is the most critical part of the business. So we basically had our inventory, we had our space pretty much built out, but we didn't have anything to put the merchandise on. So we said, well, what are we going to do? Because we had planned to do custom build-outs, but they were just too expensive. So we'd seen some furniture, and we said, well, let's just buy furniture. We'll put our items on the furniture, and we'll put a price tag on the furniture, put a price tag on the gift items, and see what sells. Well, within the first weekend, we quickly realized that that was a great decision, and that problem of running out of money actually led to a very good business solution. And it turns out that furniture from that first weekend until today, 10 years later, accounts for a third of our business. So when problems are actually good for businesses, I really believe that. If you can be strategic and be creative, problems can actually make your business better. So, when someone, when you're faced with a problem, don't despair. Try to think of it as an opportunity. So our business has gone through a lot of ups and downs, but it's been successful. We've been in business for 10 years. We've had steady growth, we've had control of the growth. And a couple of years ago, I really became interested in taking this transformative experience that I've had as a business owner and sharing it with others. And of course, one of the most important things is capital. I started looking around and realizing there's this gap. There's if you have a business for 2 years, sure, you can try and apply for a loan, or maybe there's some other way you can start a business. But how do you start a business if you never had one and it's brand new? And so I became interested in angel investing, and I went through an angel investing boot camp. Again, kind of learning on my feet. And so that is what I want to spend the time talking about now, talking about angel investing, the kinds of businesses it funds, how it functions in the overall kind of funding ecosystem, and just what makes it tick. So before we launch into the kind of specifics of angel investing, I just want to give you an overall landscape of funding. First of all, most businesses are started from personal funds. Don't despair, but it's the truth. I don't know if you read Inc. magazine, you should start reading it if you have any desire to start a business. I read it for like 10 years before I had my business. But the Inc. 500 list, if you look at the stats, 71% of the founders of those companies, the fastest growing private companies in America, cited that they used personal funds to start their business. Another 21% cited loans from friends and family. So definitely this is an important part of starting a business. Now, the really good news here is that 61% of those founders used just $10,000 in personal funds. So probably less than, I don't know how much tuition is, maybe less than a semester here at your college, or I'm not exactly sure what the metric would be, but that's how much they invested personally to get their businesses off the ground. So I think that's a very good trend, and something that is exciting. One of the first sources of capital outside your own pocketbook is your friends and family. That is completely underreported in the media. It's $50 to $75 billion a year. It is absolutely huge, and no one really talks about it that much. So it could be something like, maybe it's your immediate family, maybe it's extended family, maybe it's the friend of someone who knows an uncle who knows someone. That's what we're talking about with friends and family. So it's a pretty big, you cast a pretty wide net, and this is where a lot of businesses get their funding. After that, this is where angel investing comes in. So if you've put some money into your business and you've gotten some other people to invest who you know, then you kind of go out to strangers, let's say, the angels, and that market is about a $25 billion market. So it's a half to a third of what the friends and family is, but it's still really, really important. And then if you continue to need more capital and more higher amounts of capital, you would go on to venture capital. And that market is about 25 to 30 billion. So about the same size as angel, a little bit more. As you go along this kind of ecosystem, it's sort of like a funnel. Like you have tons and tons of businesses started, and then a subset funded through friends and family, a subset funded through angels, and then down to VCs. Just to give you an idea, venture capitalists although they're investing $30 billion a year, it's to 2,500 companies. It's a very, very, very small number. So the good news with angel funding is that the number of angel investors has increased 63% in 10 years, and the amount of capital has increased 42%. So it's on the rise. So that's something really good and a good trend that we want to see continue. But let's just kind of get into the nuts and bolts of angel investing. So I think it's really important to understand who the investor is and then the types of companies that they're looking for, because the two are obviously intimately related. Angel investors are accredited investors. That means they're high net worth individuals. So these could be professionals. So think of, people who work at law firms or in finance, professional people who are making high, good six-figure salaries. And the other thing to understand about these investors is that they're sophisticated. So maybe they've had their own businesses, or they're very smart and they've been in banking or finance and they know what they're doing. But they're not professional. They do not get paid to make an investment in your company. Venture capitalists get a salary whether or not your business succeeds or fails. An angel doesn't get any money until you succeed. So that's a good distinction point. Angels are the type of investors who they just don't want to write a check. They want to help the entrepreneur grow their business. This is what gets them really excited, to work directly with the companies. So they're going to want, you're going to want to evaluate your angel investors based on not only their checkbook, but the contacts they can make for you and the connections. So can they introduce you to strategic partners? Can they land you or get you a meeting with that next customer who's going to just double your growth, something like that. Those are some of the other things you want to look for. And the other thing, and I think Guarantee already said this, is that no two angels are alike. So it's almost worse than banking in that way, where banking has the black box. Well, each angel investor has his or her black box. So a lot of times it's geographically driven or it's industry driven. So some angels only invest in technology. There's all different kinds. So for me, for instance, I primarily invest in women-led businesses, and I'm looking in 3 different areas: organics, B2B technology, and financial services. And so then let's talk about the investments a little bit now, because obviously these are high risk, high reward. So the risk is that many of these businesses have no revenue. So it's no wonder a bank's not going to lend them any money. They haven't sold anything yet. So in order for the investor to feel like it's worth it to take this risk, they're looking for businesses that can actually grow very quickly and grow very well and give them a high reward. Let me just give you kind of the math formula that an angel goes through when they're looking at their investments. So if an angel has 10 investments, which most have maybe 10, at least 10, 20, 30, if they have 10 investments, they expect 3 to 4 of them to outright fail, and they'll lose every single penny of their money, okay? The 3 to 4 will go sideways. In other words, maybe they'll return the initial investment, but they won't make or really lose any money for the investor. Then 1 or 2 are going to be sort of, your home run hits and return 10 to a 10x to 30x return. So that means, let's say I invest in a company that someone in this class is starting, and we value it at $1 million. When we sell that company, it's going to be valued at $30 million to hit that 30x multiple. So I think you can probably already guess there's certain types of businesses that fit into this model. So they're highly scalable. So you have a kind of a modest investment the business can really grow upon that. That actually means in many cases that many of the investments that angels make are in companies that the foundation of the company is technology driven. They are also, angels like to talk about the hockey stick growth. We all know what a hockey stick looks like, right? So it starts out like this and it goes like that, right? So again, you may have no revenues or very few revenues, and then the angels going to want to see this really dramatic growth within about 3 to 5 years. The other thing they're looking at high growth industries. They don't want to invest somewhere where sort of the market is mature and done, unless there's a technology or some kind of business that is disruptive. And I'll read you from Angel List just some of the companies and how they're described today. And again, they're looking for this super high return, and so that means they need an exit. So they need to be a company that can be acquired by another company. So maybe, let's say you start a media company, you have an app that's interesting for a media company. So will Comcast buy it? Like, is there an exit? Is there a way for this company to be sold or merge with another company? So those are kinds of the things that angels are looking for. And then the size of the investment and then the type of investment is also important. This is really important for people who are starting their own business. So my business has been self-funded, and then it was sustainable. It was profitable from year two. So it's been it's been a sustaining business on its own. But when you take capital in from the outside, from angels, most of the time it's in the form of equity. So equity is when you sell a piece of your business to an investor, and then they own a unit or share of your business. Again, this is not a publicly traded share, so the investor doesn't have any liquidities. Again, just underlying how high risk it is. But basically, you're exchanging in exchange for the cash that you're getting for your business. You're giving a little piece of ownership to an investor. And when you give some ownership, you also give some control. And this is a really important thing for entrepreneurs to internalize, because at the end of the day, certain types of business and certain types of entrepreneurs are never going to want to do that. And that's okay. There's other ways to fund your business. But for angel investing, you do give up a little bit of control, you do give up a little bit of ownership. And then as you go down that kind of funding trail, and if you were to get later rounds of financing with VCs, that only increases. One thing I hear a lot of times from investors, which is sort of a great thing to just think about, is it's better to own a small piece of something large and profitable than a big piece of something not profitable. So that's sort of the counterpoint to, oh, well, I don't really want to give up ownership. Well, you know what? There is an upside to it too. And the size of investments varies, but I always encourage entrepreneurs to really find angels who are going to invest at least $25,000, because look, if you're trying to raise $250,000, that means you have to convince 10 people at that minimum level, right, of $25,000 each. That's a lot of work, even just like that. So if you were to lower it down to, let's say, $5,000, it's 5 times the amount of work that you're going to have to find 5 times the amount of people to invest. So most angel investments range about 25 to 100K, and most of the time you're raising money in the range of about $250,000 to $1 million. If you're trying to raise more money, angel investment might not be the right fit, and if you're trying to raise less money, it might not be the best fit. But there's sort of a little sweet spot for angel investment. But I think I really want to open it to questions, because I always find that some of the stories and things come out with probably have questions. So don't be shy. Kickstarter, Indiegogo. There's one for women called Plum Alley. There's many of these things. They're crowdfunding sites, and these 3 that I just mentioned, they work on a reward basis. And so this is actually, you're not giving up ownership in your company. You're saying, okay, so let's say you want to produce a movie. So you advertise, okay, I need this many thousands of dollars to hire the actors and get the location, XYZ, and in exchange, I'll give you a credit as a producer of the movie, or I will let you see the movie first before anyone else does, or I will, personally fly and see you and let you meet the lead actor. So it's rather than giving up. You're getting cash from the investor, but you're not giving equity. So you're giving a reward. So it's your time versus control or ownership of your company. And it's very, very effective for primarily artistic-related ventures. I just heard a figure that actually on Kickstarter has now has raised more money for art projects than the National Endowment Arts is given out here. So this is, when people say crowdfunding, they're kind of boo-hoo on it. They just don't want to see the future. It's definitely there. So, and angel investing is changing because of crowdfunding too. Oh, no, angel investors tend to be involved. Okay. There are a subset who, again, just like to write checks, but the opportunity to really help kind of shape and inform the growth of a business is really exciting to them. And so you have to be careful about this too, because you have to think about who you're going to be interacting with. And I actually know entrepreneurs who have fired investors, literally to return their money because they're so high maintenance. They are, on the phone with them an hour a day. They just can't run their business like that, So that is part of sort of the dance of when you're raising money. The second part of your question was,
With the investors.
oh, how do you keep track of it all?
Yeah, do they audit you?
Yeah. So this is a really good question. So when you raise money from angel investors, something's created called a capitalization table. So it outlines the value of your company and then who owns what percentage. Those are all listed basically in a spreadsheet, and that's it's usually an appendix to sort of a term sheet or the agreement to buy shares in a business. So they do keep track of it very carefully, for sure. It's not necessarily audited formally, but you want to make sure, that your amount is represented correctly, and that as an entrepreneur you have the whole view of all the money that has come in. So your accountant, lawyer, would be on that. Yes. How do you prevent fraud? So in terms of evaluating the investor or evaluating the company?
No, that's
That's a good question. I mean, just like the investor has to do reference checks and kind of do your homework about the company. I mean, just to give you an idea, an angel investor might spend 80 to 120 hours studying your particular business before they make an investment. A huge amount of time. You should do the same thing. So, and it is really important because, like I mentioned about this person who, I know who has fired an investor, perhaps if she had talked to a couple of people in a few circles, she may have learned ahead of time that person was maybe not quite right for her business at that time. So you should be just as rigorous as the angel in evaluating who it is. And if you look on a site like angellist.com, which lists startups and then the people who are investing in them, many times the reason why someone will invest in a company is because they see who else is invested, or they see that they went through an accelerator that's very well known, like Y Combinator, or there's a brand name. If a brand name an angel has invested in the company, you can be pretty sure, or a venture capitalist, you already know that tons and tons of hours have gone in. So then, so that's a good way of just, you have to evaluate the investors just as much as the investors evaluate you. Again, angel investors are all different, but they are looking for a couple of those characteristics. They want it scalable, they want it high growth, they want to see an exit. And when they invest, they are actually, most of the time, they're more interested in investing in the person rather than the idea or the product, because most of the time, the idea of the product changes so often that what they're really investing in is, can this person, with his passion and his experience and his connections and his, gumption, can he make this work? Does he have, do we think he's the one who could make this vision come to life? Or if it's not this, is he going to be able to change and do that? So that is one of really, angels do look for you. They also look, what is the market and the size of the opportunity. So again, if it's a B2B business, they want to see that you can acquire high hundreds of customers. So 800, 900 customers. If it's a B2C, so business to consumer play, they want to know that you're going to acquire hundreds of thousands of customers. So these are some of the things they're looking for. It's a really good question. Yeah. Yes. So angels, they invest in between 1% to 3% of the companies that they see. So it is easier than getting venture money because that amount is even smaller. But it's, I think, even the name angel investor makes it sound like someone comes in and kind of, it's very benevolent and good and easy, and it's not easy, but it is possible. It is possible. Yep.
Don't do it.
Venture capitalists will, once you get to venture capital, they typically take about 40%, but I've even heard of businesses just starting and someone saying, they're on the advisory board and they want 10% ownership. I'm like, Are you crazy? They should be happy to be on your advisory board. Okay, so yeah, I mean, the investments I'm looking at, I'm owning less, 1% or less of the company, very, tiny amount. So, well, once you give up ownership, you don't ever really get it back. You have to buy it back. So that's why it's very important to not to feel like it is a precious resource and to give it out appropriately. But what does happen is, you might have an investor who invests with you, let's say now, and then 2 years from now, you realize you still need more money. And they say, okay, you go back to your initial investors and you say, I need more money, the company's worth more now, so you can give me the same amount, but I'm not going to give you as much ownership. You'll get ownership, but not as much as you got before because the company's worth more. So yeah, that's a constant evolution. And there is something called a down round. So sometimes you get a situation where investors have made an investment and it's chugging along, the company needs more money, and then the next group of investors comes in and says, okay, well look, we're ready to put a lot of money in, but it's not worth what you think it is, and we're going to actually value it less. That does happen. It's very demoralizing, but in some cases it works out for the best because they need a lot of capital and they weren't really working on numbers that were kind of down to earth. They were a little bit, in the stratosphere. But you always want to avoid a down round. So that's also incentive for both the investor and the company to come to an agreement about how much the value of the company is. Of course, the entrepreneur wants the value to be as high as possible, and the investor wants it to be, well, not as low as possible, but they want it to be reasonable. We have to come to something that is actually reasonable and makes sense for both parties. Yeah, so this is changing a little bit. So this is what I like to say. You need to do your business plan because the exercise of doing a business plan is going to prepare you to answer all the questions about the market, to answer all the questions about industry trends, to answer all the questions about competition, to really crystallize your vision. I'm actually a judge on the Brooklyn Power Up business plan competition. I'm reading them right now, and they range like 30 to 40 pages plus financial statements. I mean, this takes a lot of time to do, but it is sort of it's sort of the cost of entry if you're gonna have a business. You need to think through all these things. It's not an idle exercise. But to counter that, there are lots of pitch competitions and other things where they say 500 words or less. Why should you get $100,000 from us? So there's sort of shorter, more concise, sharper forms are emerging where you might submit a video that talks about your target customer, and maybe there's 1 or 2 slides that show financial projections or a SWOT, and then you basically have like 1 or 2 pages talking just about your business. So the investor deck, let's say, your PowerPoint or whatever it is for your investors, tends to be a lot shorter than your business plan. And there likely are some investors who will never ask to see it, but trust me, they're going to ask you the questions that you will have had to answer if you did the business plan. If you didn't do the business plan, you're not going to be able to answer the questions. And so that's sort of my view of it. This is actually great because the program that I did to learn about angel investing, this is exactly what we're trained to do, is to evaluate companies based on triple bottom line. So is the business going to be profitable? Is it going to be environmentally responsible? And is it going to have a social impact? So, being profitable is not good enough anymore. And you see this changing with the very large corporations. They're scrambling to tell all their customers how green they are and all these great programs and how they're giving back to communities. A lot of businesses started today. This is already baked into the mission of the company. So, one company, for instance, I've invested in, they make products related that are based on cocoa, so like baking mixes and hot chocolate, things like that. Well, the idea about this business that makes it so interesting is that not only are the ingredients organic, but this woman has found a supply, a source that's fair trade certified, and it's not even fair trade certified. The employees own the farm. It's not, from another country who owned and operated the farm. It's the actual workers own the farm. And so this is why you're going to want to buy this product, because you know that by demand, by buying this product, you're creating demand for their enterprise that they own. And you are actually changing their quality of life just by drinking your own cup of cocoa. So absolutely, triple bottom line is going to start to be the cost of entry for businesses. I mean, it is changing. Most companies fail. Most companies fail. You should all know that, and that's actually, that shouldn't be a deterrent. Many successful companies, the founders are on their third or fourth company, and the first one or two just fail. So yeah, securing capital doesn't ensure your success, but most businesses fail because it's not because their idea isn't good or the timing isn't right. It's just that they don't have enough cash on hand to get through, to grow the business big enough, quickly enough, and to the point where it's self-sustaining. So that's why capital is so important. But again, just because you have it doesn't mean, for sure you will be successful. And there's a lot of other things that go into it. But I think the most important thing for a business, these are my four-word mantra for a success in business: follow up, follow through. I guess those are hyphenated, so maybe you count as two words. But if you do that in whatever business you have a tremendous shot at making your business successful. And that, I can't tell you, I work with hundreds of companies, and the number of them that do that on a consistent basis is astoundingly low. And they would do so much better, they have so much more my business if they just followed up and followed through. So definitely I think that's the most important thing. So I have a list of resources. There's angel networks. Angel networks are good to work with because you'll pitch a whole group of angel investors. So even if the fund itself doesn't want to invest, maybe one or two of the investors on their own will want to invest. And there's all different sites that list different angel funds. And then it's really, working your network, finding out who knows someone there, and getting a good advisory team, accountant, lawyer. You want those two people in your business to have helped businesses start and grow. And you really want to hope that they have connections to capital sources. Either, they know people at the bank to help get you loans and lines of credit. They know angel investors, and they know VCs, all those kinds of things. There are lots of online formats now. So there's angellist.co. There's Funders Club. There's Circle Up. Small Knot is another rewards-based platform.
There's a lot.
There are tons. I just saw an article. There's 20. It outlined 22 different crowdfunding platforms alone, and it was missing a few that I knew. So there's a lot of different ways. But I can send you. I'll send. Yeah, and then if I could, I just wanted to read a couple of the descriptions of the businesses that were advertised to me just today via email. So just to give you an idea of like how companies are pitching themselves, what they're saying, I think this will be instructive. Okay, this is from Funders Club. Funders Club. Okay. So here's one company. Y Combinator-backed platform that allows developers to integrate a white label Square-like experience into their applications. 200,000 annual run rate revenue, growing at 65% month over month. Initially attacking a $1.2 billion card present mobile payment platform. So just listen to this. Lovely, here's another company. Lovely is an apartment rental marketplace disrupting Craigslist as the go-to platform for long-tail apartment buildings. 500,000 monthly active users in the U.S., 50% of all active apartment hunters in San Francisco. Early monetization strategies have yielded 625,000 annual run rate revenue, 38% month over month. $5 billion market opportunity. Here's the last one. Andreessen Horowitz-backed marketplace, B2B, disrupting the $200 billion U.S. meat industry. AdLocal allows independently run farms and restaurant retailers to connect and buy farm to table in a more efficient and novel way. But I think you see some some patterns there. They're saying disruptive, they're talking about the market size, they're talking about how fast they're growing their month-over-month growth and the size of their revenue. So, well, let me give you 2 things right now. You can follow me on Twitter, and I post all different like business plan competitions, call for applications, articles about funding, all that kind of stuff. It's at G as in girl, Crowell, Crowell. And I'm also writing a series on the nextwomen.com about funding and financing businesses, and each article is devoted to a different type of financing. So the last one I just did was friends and family, did one on angel investing, venture capital, bootstrapping, accelerators, incubators, microfinance, business training programs. There's so many of them.